In this video, you will learn what protective puts are, how they work, why traders use them, who should be using them, and an example of how to set one up, including calculating your maximum profit and maximum loss with this options trading strategy. So a protective put is one that you would buy as an insurance piece to a stock that you already own. When I walk through the example later on in this video, we're going to be looking at my position of Airbnb right there with 100 shares and how to use a protective put to protect the downside risk given Airbnb's upcoming earning date. So fundamentally, if the stock price is trading right here and it decides to drop, when you buy a protective put, what you are doing is just limiting your loss, LL, of this downside move right there. So instead of losing X amount of dollars, maybe it's 100, maybe it's 200, you're going to be losing less. We're going to show you the exact way to calculate this in a little bit. So they are a loss limiter, much like a stop loss. Instead of being bound by a price, they are bound by time. Okay, so the time in fact for this option is how these ones work. They are bound by time, not by price. And why traders use them is because when there's events like this, and there's a bunch of uncertainty in the market, and it's prone to potentially have the stock price go higher or lower, and you just don't really know sometimes, it can be a good practice to limit some of your loss. Again, the whole LL concept, right? LL, loss limit. And doing this type of trade to protect this downside loss on your stock would be thought of as a kind of risk management strategy for your portfolio. Traders often use limiters like this because there's just so much uncertainty around certain events and they have potential profit in their account, as you can see here in this position, $2,238, that they don't want to necessarily give it all away. So they'll use kind of loss limiters like this and other strategies to potentially reduce the amount of loss they're going to take on a position, assuming it moves against them. Why do you get life insurance? It's because sometimes bad stuff happens and you need to have the protection when there's a downside move. It's no different in this example with the stock and Airbnb coming up. This strategy works best when you have a long-term bullish view on the stock or anticipation, but a short-term maybe period here again, where it may be a little bit uncertain, or you think it may be bearish where it maybe kind of pulls back and then it's going to continue to go up later on. That's the optimal scenario for running what's called a protective put. And these aren't for everybody. If you don't know how to use options, you shouldn't trade protective puts. If you're a new trader and you understand the basics of options, how to actually execute and do this, it's probably okay to do. If you're kind of an experienced trader, 1 to 2 years under your belt with options, it's probably okay to do. But if you're like brand new, fresh, if you're a freshie, right, noob right there trading, it's probably not something you want to try to do right away because you have to understand how to execute it and how the potential profits and losses work with it. So I'd say a little bit more moderate, beginner-ish, but moderate kind of experience to actually execute this and do it properly. As long as you understand what's going on, you can definitely make this trade. But I will say, there needs to be this guy right here in order to do this. You wouldn't just go and put on a protective put for no reason. There has to be a reason or some understanding that this is a loss limiter. There's an insurance policy you're going to have to pay for. So this has to be there. You're not going to just go one day and just say, hey, let's put on a protective put just for the fun of it. It's going to lose you money if you do that. There has to be a reason. So understand what your reason is for getting this insurance product on your position. And then also understand this is not for, as well, people who are long-term bullish. If you only think that the stock is going to go up and there's going to be no pullbacks along the way, good for you. Like, that's not realistic in some cases, but if you're long-term bullish, this isn't what you want to kind of get in your portfolio. If you're a long buy and hold, a B&H investor, this isn't for you. You don't need to kind of get involved and do it to this level if you're just going to hold a stock for 10, 20, 30 years. And if you're a very recreational trader that only invests a small amount of time and you're not going to want to check your account every day or every couple of days, this probably isn't for you. So if that fits you, probably don't use this strategy in your account. It's for those who have a little bit more time, who want to kind of trade, get a little bit more juice out of their accounts, protect their risk, and who have a short-term potential bearish movement in their mind with long-term bullish beating expectation. So now let's go through and show you step by step how to set this up. I'll be using interactive brokers, and shortly after this, I'm going to show you those maximum profit and maximum loss calculations so you really understand the numbers with this strategy. Now, we would go in here and click on our position, or whichever one it may be, where you want to sell the protective put. You have to have 100 shares in your account, which we do here. We have some unrealized profit, which is good. We bought the shares at 122.40. The current price is 144.78. There's roughly $2,200 of unrealized profit. That's great. We want to protect some of this. So what we want to do is then go ahead and look at the strike prices and the expiration dates. The expiration dates first are going to be governed by when you think the kind of bearish or bad move is going to happen. Now, we've said we have earnings coming out on the 13th of February, roughly 8 days away. We want to target an expiration date around this earnings date because this is our area where we think that the stock may be going bearish based on just the uncertainty around earnings. If that date was pushed out till May, you'd probably want to have your expiration date in this range right here. But since we are targeting February 13th, we're going to target that in Interactive Brokers for our expiration date. Just keep in mind that the closer the expiration date is, the more that the theta is going to get chewed up, and this value of this put option that you're going to buy is going to erode very quickly. So try to ballpark this expiration date here around the event or the expectation of where the bearish move for the stock may happen. It's hard to do, just like when you're buying any kind of call option, when you're trying to make it go on the upside. It's a very hard thing to do. But again, this time we're protected a little bit because we own shares of the stock and we're using this for insurance versus making a bunch of money by going long buying calls. So let's go February 16th right here. And let's go for a strike price that we want to go. Strike price is going to be below the current stock price. And the reason for that is that we're buying insurance, right? We want to make sure that we're protected if the stock price goes down. So if the stock price goes up, that's fine. We'll show you what happens there in a second. But if the price goes down, we want to have protection. So to do this properly, buy a put option on the downside. I'm going to target 140 because it's a nice round number for math. And there's pretty good option volume right there at 237K. So 2,000 option contracts in play on this strike price. So I would just go ahead there and just make sure I'm blue for buy inside Interactive Brokers. I'd go buy, limit order. I would do my limit and it would be between the bid and ask. So I'm going to go at 4 right now to make things, again, easier for math. It'd probably be closer to 397-ish if we're doing this spot on, okay? Then you'd go ahead and go day or good till canceled, probably day. If you're going to do a day trade, you'd go then submit and put this in your order area down at the bottom to get filled. And once it is filled, it'll be in your account right there near your position. And you can actually sort these by name if you want to. It will get in there right underneath Airbnb. You'll have your contracts with your positions there for your shares, plus your protective put once this fills in your account. So before you do this, ideally, you want to have an idea of your max profit and max loss. That's where we get to right now. Flipping over to my spreadsheet here, we've got it set up here at the top. So what do we do first? We bought 100 shares of Airbnb right at 122.40. That cost us $12,240. Currently, it's trading at 144.78. We have an unrealized P&L around 2238. Okay. What we just did, we bought a protective put right here. Okay. This is what we just went through and did right there. Boom. All this is what we just did. So we have a stock ticker of Airbnb, one contract, which is 100 shares, strike price of 140. We had to pay $4 to do this. So $4 per share. So $400 in total. I'm going to leave it at $4 right there right now. And expiration date is February 16th, 2024. So coming up pretty soon. Now to calculate our maximum gain and maximum loss, and I'm going to also walk you through on the whiteboard what would actually happen in these scenarios. The maximum gain is super easy, okay? If the stock rises, and stocks can go up and up and up forever, right? They're unlimited. You can have stocks go down to a limit of 0, but they can go up and up and up on, we've seen it with things like Nvidia and Facebook and everything else lately that just, it keeps going up and it just keeps rolling. So if Airbnb goes from 144.78 down up to 150, here's how you'd calculate your maximum profit. You'd have a gain on the shares from 144.78 up to 150. So subtracting this 144.78 from 150 gets you $5.22 per share, just like that. You multiply that by 100, right? And that gets you your 522 total for your gain, okay? Then you paid $400, remember, so 4 times 100 is 400 because there's 100 shares in every single options contract. So you would lose that premium that you paid to buy your protected put. So you lose your insurance money. Just like when you buy life insurance every month, you lose that premium, but it goes towards your policy. So you're okay paying that out every month. In this case, we'd lose this. So we'd go 522 up here minus 400 equals 122 for your total gain. If you compare that to not buying a protective put, your maximum gain obviously is just this top line here. You don't have any subtraction of this because you didn't do it. So your max gain, if no protective put, would be 522. So you see how it limits your upside on this kind of trade. If the stock price for Airbnb goes up to 200, it's the same thing, right? We go 144 up to 200. We subtract the difference between those two. It ends up being $5,522. We again subtract or deduct the cost to buy the protective put, our insurance, from the total there. So we go 5522 minus 400, total gain 5122. Again, if there was no protective put in place over here on the right side, we would have a maximum gain of 5,522. So we would essentially be capping some of our losses if we buy a protective put and the stock price goes up. That's okay because we are making these gains. We're just not making as much with the protective puts if we have them on place. So that's what you pay for in terms of the insurance. That is best case scenario right there if the stock just decides to rise and your protective put would expire worthless. In terms of how this would look on a stock chart, right? The profit is unlimited. If the stock price just keeps shooting up and up and up, right? We have our stock right there or our shares, and they're going to be going up in value as well, dollar for dollar, right? That's great. They're making money right there. That's a plus. But our protective put, our PP, is going to be a negative dollar, right? So then we just subtract the two and we get our total profit by doing it this way. You don't have to do anything in terms of exercising the contract. It would just expire worthless and it would just be deducted from your total position, assuming you wanted to go ahead and sell the stock at this high point right there. If you didn't, you can keep the stock and you can keep going further and further and further and further, and you keep making more money on this top line because you own the shares while only having to pay this protective put once or however many times you make the trade. If we look at the maximum loss, okay, the maximum loss is a little bit different. And this is where it gets a little bit tricky. And you'll see why it's important to have protective puts on in certain scenarios more than others. Let's say Airbnb's price drops from 144.78 down to 140, okay? So on the shares, we'd have a loss because they'd be going down in value. We'd lose $478 on the shares. So when we sold them at 140, okay? That's just a difference between 144.78, where they're trading right now, down to 140, so 478. We would also, again, lose the premium of the protective put because it went right to our strike price of 140. We wouldn't exercise anything. We wouldn't be moving with the shares around. We'd just be losing that premium on the protective put. So if we add these two together, 478 plus 400 equals 878 total loss. If there's no protective put, our max loss is just 478 because we wouldn't have any of this protective put to take into consideration. So it would just be 478 and that would be it. So the question may be coming like, why would you do this? Well, it's when it goes beyond the strike price of 140, okay? If Airbnb's stock price drops down to 130 or below, the protective put is going to cap your loss, okay? It's going to cap it at the same 878. If it went to 140, if it goes down to 130, anywhere below 140, it's going to be capped at that 878. And I'll show you why in a second. But this is the key thing here. You can exercise this protective put. That's what it's there for. When the stock price drops hard, you limit your loss. You sell your shares at 140. And I'm going to show you on a diagram here as well. So you would be then, again, losing your shares down 478 because you sold them at 140. That's what the protective put's there for. You would then lose the premium of the protective put because you paid that up front and you just bought that put option. So you're down 400 again. So total loss was 878. If you didn't have a protective put and Airbnb's price dropped to 130, the maximum loss would be 1478. So there's where the value there lies. Your max loss is unprotected here. 1478 is just the difference between 14478 minus 130 times 100. So you get 1478. But with a protective put, you can limit your loss here down to that 878 level. So how this works with more of a visual flow, right? We've got our stock price at 144.78 currently, right? We'll put that there. There's our calculation for calculating max loss, which we'll get to after the first example. So if this goes down, right, to 140, okay, if you do the subtraction, again, it's $478. That's our loss on the shares. We paid $400 for the protective put, right? This is shares. Let's go SH. So now we have a total loss of 78. What if Airbnb goes from 144? Again, we just talked about this. We're going through it visually for you to get the concept down to 130. Well, you would normally have that loss at like $1,400 loss, but what you can do, the protective put allows you to sell your shares, right? Sell your shares, and stay with me on this. You can sell your shares. That's the best R I've ever driven in my life at, right, $140. The stock is trading at 130. Let me change this up. This is important. You have to understand this. The stock's trading at 130 in this example, but you can still sell your shares at 140 because that is the protection that your protective put gives you. It gives you this ability to keep that on the table. So in essence, your max loss scenario is still this same calculation up here, even though the stock price is trading $10 lower at 130 per share. So how this would look at expiration, if it was a 130 stock price for Airbnb, you would exercise your protective put, right? And that would equal selling at 140, okay? So you'd lock in a loss there of 474. Again, by exercising this protective put and selling those 100 shares, if you wanted to, you could always just let the stock go lower and let this expire. But if you exercise your protective put, you have this locked in at 474. You lose the capital for the protective put because it's the cost up front of doing business and having the insurance. So again, you end up merging these two, and your max loss is 874 versus 1432 and change. Okay, so this is where the protective put really comes in handy if it is a downward move and you can kind of limit some of your loss in this example. The max loss calculation up here, current stock price 144.78 minus the strike price of the protective put 140 plus the premium paid for the protective put, which is $4 right there. We're going to put these in a nice bracket right there. If you do all that math together, it equals 878. And you can see here that we've got times 100. So we just go boom, times 100, because there's 100 shares in each contract. And you just move the decimal place over 1, 2 to get there. 878 equals max L bag. Okay. That is the max loss calculation. That is protective puts in a nutshell. If you want to use this kind of as a guide, go ahead, be my guest. But again, you want to use this when there is a potential unknown or bearish scenario to protect your max loss. And if it's a bullish long-term stock where there's going to be a lot of gain as well, you do this temporarily and you kind of pay for the insurance up front for the potential payoff long-term when the stock appreciates over time. So thank you for watching this video on protective puts. I hope you got some value. If you did, please leave a like on this video, comment if you have questions, and I will see you on the next one.